Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? Phil Tarrant, host of the Smart Property Investment Show. Hope you're well. Some data coming out lately. It's just a sage reminder of the compounding growth that is property investment if you get it right. CoreLogic only this week, 30+% growth since the COVID pandemic hit. And to me, it was just a nice connector to stop being annoyed by having a largish property portfolio and everything that entails to the upsides and the outcomes of a really good property portfolio. So I often get my capital growth calculator out and play with the numbers, sort of 5 years, 10 years, 20 years, just see what things look like. And you look at the numbers and think there's no way that that's possible. But if you go back through time, it would appear that property does grow at a pretty reasonable rate. It goes up and down, left and right, depending on the year and the cycle, but consistent growth over time. Property is a really good performer. So hence the reason why we do the Smart Property Investment Show, to help you make more informed property investment decisions. And I bring people in the show to have a chat that's sort of outside of my skill set. I'm but a journalist whose job it is to talk to people that know what they're talking about. One of them is Lachlan, Vidler, the director at Atlas Property Group, joining me in the studio. To pick his brain to see what's going on in this market. He reckons, from what I understand, that there's going to be some halcyon times ahead of us in terms of capital growth as a number of different factors come into play. Lachlan, how you going?
G'day, Phil. I'm good. How are you?
Good. First time we've spoken this year.
It is. What are we? March. Wow.
March already.
Tell you what, we're end of the first quarter of the calendar year in about a couple of weeks. It's flown, hasn't it?
It's the way it is. But property always marches on.
Property
There's always
does.
a story. There's always a story around property. It's a gift that just keeps giving.
It certainly is.
Particularly if you are a property investor. I know a lot of people are looking to get into the property market. There's a lot of noise at the moment around housing affordability, as there always is. You've got certain elements of the government, whether it's the opposition or independents or Greens, banging a drum around housing affordability. Everyone's got grand schemes to make property more affordable, and it all comes back to the same position that we need to manufacture a lot more dwellings than what we are doing right now. But what does that mean for property investment? It's probably going to be consistent with the ongoing growth that you're going to get over the years. So all these different universal aspects of property investment and the property markets in Australia is going to drive market demand moving forward. I know this is where you do a lot of work. Lachlan, what's your big headline for 2024?
What is my big headline for 2024? I think that my big headline for 2024 would be property market surge. I think we're definitely going to have a talk about some data and some different things as we get into the show. But I think that realistically, if I was going to sum it up, we're talking property market surge. And that's as simply as I can put it.
Everywhere or just somewhere?
Everywhere or just somewhere. I mean, I can't say everywhere because somebody out there will find the one suburb in 2025 or in 2025 come back and say, oh, this was the one suburb that didn't. But I think broadly speaking, I think that it's going to be pretty well received. I think there's obviously lots of factors that go into it, but I think the affordable markets continue to move along quite well. I think the top end of the market has a lot of elasticity depending on what is going on in the environment around, and considering what the rest of 2024 from an environmental point of view looks like. I think that's going to probably look pretty good as well.
Okay, well, let's have a chat about it today. Before we get there, last time we caught up, Talva.
Yes.
How's all that going?
Yeah, Talva. So Talvr for everyone out there. Got to spell it out while everyone gets used to hearing it. Talva's doing really well. So last time I was in, we were chatting about it. So it's a business I've launched with some outside people, and it's about an integrated property performance platform. So you jump on there, you input your portfolio, you get valuations on your property, you can track your cash flow, you can export your report straight to your accountant. You can basically manage the performance of your property rather than having to do it in Excel. You get nice graphs, you get all that sort of stuff. So it's fantastic, very user friendly, and it's doing fantastic. So we've had a few thousand people join the platform already. Very little marketing that's gone into it, and it's just things like these mentions. on a podcast here and there. And the feedback's been phenomenal. People are really loving the simplicity of the platform, really loving how interactive it is, the visuals of the platform. And we've got some big updates coming. So we're going to be updating the client side, which is what most people see, that sort of consumer end where you put your portfolio in. But in the next couple of months, we're actually going to launch the business side. So that's going to be for your property professional to jump on, and then they can manage your portfolio. And then there's also going to be really cool things like you're going to be able to track your client journey. So if you're working with a buyer's agent and you've you're at a different stage, whether they're finding you a property or trying to work out where you're going to buy or things like that, you're actually going to be able to track your client journey on there, chat with your buyer's agent through like a messenger style platform, manage that portfolio side behind it. Just a very interactive, almost like for those business people out there, almost like an outward facing CRM, so you can feel really integrated with your property professional rather than what, I hear from a lot of people. They just don't necessarily know where they're up to. It can be really hard just doing emails or phone calls just because there isn't anything out there to help them in the way that, Talva's going to help them.
Okay, well, it's good to hear it's going well, mate. And having a better relationship with your portfolio makes you a better property investor. And a lot of people sort of struggle with it. They might not be an Excel wizard. So it's good to see there's support and help out there. The property market. Tell me about what's going on. Where are we at? You sort of got the jitters around, the propensity for capital growth, considering still uncertainty around interest rates, or do you think they're going to start coming down, or is that going to be a catalyst for changing growth dynamics?
Well, it's a good question, and I want to give my thoughts on interest rates a bit later on, probably in our next part that we're going to chat about, but. Where do I think the property market's sitting? I think it's sitting in a very, very interesting position. I think that, just looking at some of the data, so I think it was today actually, CoreLogic brought out their monthly set of data just to give everyone the basic overview. And if we look at the 12 months to March, February last year, right? So what's that, 22 into 23?
Yep.
National property market went down 7.9%, right? Which probably wouldn't shock a lot of people. It was when rates started to move. Of that negative 7.9%, probably a lot of it was in the tail end of 22 into the start of 23. So I'm sure that wouldn't shock many people. But as of, I think, like I said, today, in the 12 months from last year to this year, we're up 8.9% nationally. So markets are moving. And markets are already starting to move. And I mean, I see that day to day with the work we do for clients because, we're out there, we're chatting with agents, we're buying properties, we're obviously researching new locations, we're keeping up with the research on our current locations. And I would honestly go and say, it almost feels as tight, if not potentially tighter, than in that sort of 2020, 21 period where everything was going crazy. And it was really hard to buy, right? And I'd say there was more stock then than there was now. We don't have that same level of interest just yet, but it's coming. It's really coming. So I'd actually say this is some of the tougher buying conditions I've seen.
It's funny you say that because a lot of people invest in little bubbles. So their frame of reference is maybe 6 months, 12 months in the past or into the future, whereas the best investors I know have a decade mindset. Now, it's a great story, and there's relevance to this. I think it was, and I'll probably butcher this a little bit, but I think a Chinese diplomat was chatting with a French diplomat, and the French diplomat said to the Chinese diplomat, "What do you think about the revolution in France in the 1700s?" And the Chinese diplomat, "It's too early to tell," right? So this is the view of thinking generationally, the sort of seismic growth in China, and it takes a long time for things to compound. Whereas the same applies in property investment. Now, you're not thinking, well, generationally, there's those generations who have held property in Australia for many, many generations. They're doing extremely well, and their families on the rich list. There is those investors that start earlier in their property journey and they end up with quite large portfolios holding it for 40 or 50 years, so they're doing well. But most people make their investment decisions based on what's happened over the last year or so. So they get absorbed with it and they think, wow, why? And the question, and I'll pose it to you, why is property still growing in value when interest rates are so high? And the response to it is, well, interest rates aren't high. If you look back over time, they're quite sort of average. So this market is quite a healthy market. This market represents a lot of the norms you would actually see, but overlaid with some of the challenges that it's facing in terms of supply and availability. So to your point around growth in the market, it dropped by 7% was 22 to 23, 23 to 24. You said it's grown by 8.7%. And the most recent numbers saying that property is up holistically 30% since the COVID pandemic started. So it's gone up, it's come down, and it's back on the way up again and surpassed where it was pre-pandemic, 30+%. So how do you capture the idea of get on board property right now, because it should over time generationally continue to grow, but with a decade point of view, it's going to be very, very different.
Well, I think you're definitely right there in saying that we do need to think generationally. So something that we do for all of our clients is we'll build out a portfolio plan for them, right? To say, you're here today and then this is whatever your goal might be and this is how we're going to map out to get you there, right? And it's buying whatever properties in whatever time frame, doing all that. And what a lot of people are really surprised about when they see their portfolio plan is that it actually, especially when you adjust for inflation, and that's something that's a lot of people forget to do. We all talk about, let's make $100K, $2K a week type of thing, get that $100K passive income. And I know there's a lot of people out there as well, a lot of businesses that sort of do what I do that will sell people on the idea of, I can get you $100K in 10 years or something. But it's never inflation adjusted. And I guess how I'm linking this back to what you're saying is that when we build out those plans, what I'm often saying to people is like, for a lot of people, they're the first generation of wealth, right? They're the first generation, they're building it. And it takes a bit of time. And it's really important when you are trying to build out a portfolio and acquire property that you are doing it through that lens, that if you are that first generation of wealth, that it's going to take time. And something I say to a lot of people is, that sucks, right? Like we'd all love to live a lavish lifestyle and we're born into it and we've just got money and we never have any concerns about money because that's one of the leading causes of divorce and relationship breakdowns and things like that. But the reality is that's not the case for most people. And if we're going to be that first generation in our family to do it, then the unfortunate side is you're going to reap some benefits, but they're going to happen much further down the road, right? And you can still lead a much better life today, of course, but it's then that next generation that feels it. And then if they don't squander it, then it's the next generation, right? And I think what's the adage? It's like one generation builds it, one generation, enjoys it, and and then the next generation loses it. So you have to do your best not to do that. But I think you're bang on the money there where people can be at risk of thinking short term. Like we literally actually had a client who came in this week. We're still waiting to see if he'll sign on with us as a client. But he said to us, I want to buy my own home, but I don't have the money to do it. But I've got the money to invest in property. And I said to him, well, that's great. And if you want to buy a property, we'll buy you a great property. I'm sure it's going to do very well. Come, let's have that conversation. And he said, okay, but what you need to understand is that I want to then sell this property in 2 years and use the capital gains from that property to then buy my own home. And I said, okay, that's okay. But what you have to understand is you're now matching a long-term asset with a short-term problem. And it may come off you, right? And like we've got great performance, right? I think we talked about maybe on our last episode, like our average lifetime capital growth rate each year is like 19.6%. So it's massive, right? And judging by what he wanted, that fits in. But it's still the wrong approach. And I said to him, if you want to buy a property, that's fine, and we'll help you. But you need to understand that if it doesn't come off the way that you want, that's because you've matched a long-term asset with a short-term problem. And he turned around and said, okay, I get that. That's fine. And I'm willing to take that risk. But if you don't have that advice or you're not able to look at that, you might be doing that yourself and you might be matching a long-term solution with a short-term problem.
And thinking sort of longer term, I would imagine should this client progress down that pathway and buy an investment property, maybe two investment properties for a period of hoping that it lifts in value, he's going to extract that money and use that as a deposit, or he's going to sell it completely.
He wants to sell it.
So you take his deposit out and all the capital growth,
Yeah.
then get some more debt to buy a family home using that as a deposit. I would challenge that when he gets to that point in time, he'll go, I'm going to keep the investment property.
Exactly. And I guess it probably just fuels that conversation even more to go, that client is stuck in that mindset of he wants his own home, which is okay, but he's now trying to use an investment asset that is probably going to lead him to having a better life and then potentially compound that out into a bigger portfolio for something that is, a very short-term type of thinking. And sometimes you have to play the long game, right? And you have to play that psychological warfare, right? Of knowing if we get that client in and we do the good job and deliver what he wants, even though, as I just said, right, it's still a long-term asset with a short-term solution. If we can deliver a short-term solution to him as well, trying to play that psychological game with him to now go, okay, you've seen what can be done. Why don't you now just try and think a little bit bigger, right? And I think that's probably one of the hardest sides of our job is helping people to, from an investment mindset grow and not just stay stagnant.
Well, it's shifting mindsets and you need to have an attitude and aptitude for embracing change. If you want to be a successful property investor, you've got to challenge yourself and your own assumptions. But that happens over time, and it all comes down to education. One of the reasons why we do the Smart Property Investment Show and bring people like Lachlan in for a yarn around it is because it should help shape and change and challenge your perceptions towards property and give you greater perspective on being a better property investor and surround yourself with different views and different opinions to help shape that. So I'd imagine that's what they'll do, or they go, hey, this is working really well, let me get another property, and they'll end up sort of renting forever probably and whatever. But I generalise. But so your thesis is short-term growth at an accelerated rate, or is it just what we think is sort of annually sort of going to be operating in that 8% range, do you reckon?
Do you mean for this year?
For this year, yeah.
Oh, I'm always so careful to say a number. I'm a big believer.
I'm always getting, my job is to get numbers out of people.
I know. And I feel like we have this conversation every time as well. I was literally on the phone yesterday to someone who asked the same question. I said to them, if a bank with tens, if not hundreds of people working on this solution come up with projections that are so wildly wrong every year, how is any other business that does not have the resources that a bank does going to come up with an accurate answer?
Yeah.
So I guess what I will say is I can't give a number, but I think that we're definitely looking towards double-digit growth, right?
Okay.
I think I'm very confident in saying that. I mean,
at a national level. Good, but then that's just like a catch-all. That's overperforming markets and underperforming markets.
Yeah,
so.
I mean, look, obviously I know that there's going to be individual markets that are going to absolutely do that. I mean, we had individual markets that did that when the market went down by, multiple percentage points. Considering we're at 8.9% from, February 23 to February 24, and given we've got the, impending tax cuts, we've got impending rate cuts, we've got continued migration, not at the same level as it was for, maybe 12, 18, 24 months ago, but still a very healthy pipeline. We've got dwelling approvals at the lowest rate since 2012, June 2012, and yet a population that continues to grow. Yeah, I wouldn't be surprised if the national property price, does increase by double digits.
Yeah.
It would not surprise me if we're already at 8.9 and I think about where we were in July last year or May last year, So, yeah, there you go. You've finally got a number out of it.
Well, there we go. Well, hopefully it does that because that's it's nice for my portfolio. Welcome back, Phil Tarrant from Smart Property Investment, chatting with Lachlan Vidler, Director over Atlas Property Group. Now, interest rates, we sort of touched on it a little while ago, and property markets have bearing to the direction of interest rates. But so I would say even in the fastest rate of interest rate growth over a period of time, we've had quite considerable growth still. So sometimes these things don't always sort of work in parallel. Most economists and banks are forecasting or predicting in interest rate reductions this year.
Yeah.
Whether or not that's going to immediately mean cheaper interest rates for everyone at the actual Bowser, who knows? But there's going to be structural shifts to the official cash rate. Do you have a view yet when it will happen, if it will happen, how many will happen, and what will happen if it does happen?
So many what ifs,
What
right?
ifs.
So many what ifs.
Yeah, crystal ball gazing.
Yes.
Yeah.
Well, what do I think? Well, what I'll say is I think there'll be at least a cut this year. I would not be surprised to see a second. I think the big dilemma that is being focused on right now by the government and the RBA. I mean, the RBA is separate to the government, but the big thing that's being looked at is managing inflation, managing the economy, managing growth, and not allowing one to leave the station too quickly. And I know, and we see that from the RBA minutes. I mean, the RBA has obviously just changed their structure, but we see it from the RBA minutes and also just opinion pieces that are coming out from former RBA board members or governors, leading economists, that the big concern is that by even introducing one cut, that could very much fuel the property market, right? Like beyond exponentially, right? That's the big fear. But for those of you out there, there's a really cool tool on the ASX website. It's called the RBA Rate Tracker, right? And basically what it does is, without going into the details of it, utilizing all their cool fancy back-end stuff and looking at the way the markets trade, they make a rolling prediction each month of where they expect the cash rate to sit. And having a look at it this morning, I did it last night. I looked at it this morning as well just to see how much might have changed. Not too much, thankfully.
Yeah.
But the first rate cut, assuming it's going to be a 25 basis point or 0.25% cut, is being anticipated around July or August, right? And then they're expecting a second cut down. So the first one would take us down to 4.1, and the second one would take us down to 3.85. They're expecting that around December. So, traders are already pricing in potentially two cuts. Now, I think that one cut is probably almost a guarantee. I don't really see a scenario looking at data, because a lot of the data is obviously lagging as well. So when we're seeing inflation coming off the back burner, even trimmed inflation for those economists out there, which can be a little bit more of a more accurate measure, even that's starting to come off the back burner a little bit. I'll be surprised if we don't get one. But I think that, realistically, if we look at how all this then impacts the housing market, we've just gone through, percentages of increase. And yet the property market, whilst nationally it went down, right, there were still that many markets out there that outperformed. Like, again, last time I think I was on the show, I said in FY23, so July 22 to June 23, for all the properties that we bought for clients in that period, we had an average capital growth of 23.6%, right? When the national market went down 4%. So, for us, we outperformed by like over 26% basically. That was happening everywhere, right? And that was with rates sort of going up.
On the way up.
Right? And that was when sentiment was very, very shallow, right? And sentiment is probably one of the biggest drivers of the property market as well. And the Westpac Melbourne Institute Consumer Sentiment Survey, it's a very famous one. It's basically the most common one that comes out. They unfortunately the new one wasn't out by the time we could do this podcast, so we'll see when when that one comes out for March. But in February, that came out. And it was up 6.2% this month alone, or the month of February alone, 6.2%. It's at its highest level since June 2022. And it's only I think it's only going to be moving up. And then once that continues to move, once media continues to get louder, which as it does, it's either the putting smart property investment aside, the big mainstream media, right? It's either the best time or the worst time to buy property. They're already starting to sing the tune of, oh, you'd better get in, right? What's going to happen as we get closer to that July-August rate cut expectation period, right? They're going to be singing it. Sentiment's going to continue to drive. People are already pouring back into the market, right? New finance commitments up 8.5% compared to 12 months ago. So all these factors are starting to snowball to say this is going to be a very exciting year, right? And I think especially the second half, it is going to be so exciting. And the problem is, and I'm going to call it out right now, the problem is people are going to sit on the sidelines, right? I've literally got it's not a client right now. Hopefully it will be. I've been speaking to this person since the 16th of January, and it's now the middle of March. They still haven't pulled the trigger. Over that period, we've already bought properties and had them revalued 5 to 10% higher in that period, right? So there are going to be people out there who sit on the sidelines and they're not going to take action, and they're going to miss it.
Yeah, and it's always the way, and you always have people that do that just need something else to happen. And again, you can't invest in bubbles, in isolation. You've got to, if you're going to participate in property investment, you've got to participate in market dynamics, most of which you can't control. So for me, the key to all this is accessibility to debt. So there might be really good intent from people to enter the market, but whether or not you can service debt is the key thing. Now, if you've been able to get debt with serviceability probably at its highest point for what will be for some time, I know the banks have dialed back some of their buffers, providing sort of 1% rather than 3% sort of buffers for refinancing. But as interest rates starts coming down, I think you're going to get a lot of competition from lenders who are going to be chasing that money. So, and I say to investors now, get yourself ready for a downward rate cycle, because while the banks are quick to pass on interest rate hikes, they're very slow to pass on interest rate reductions. So you will find that new to bank customers will be getting the best rates. So you've got to sort your stuff out and be ready for refinancing and or securing debt to enter the market or capitalise on the equity that you may have increased over that period of time.
And I think you're right when you said accessibility of debt is honestly one of the most crucial things. And I think that, if I was to sum up why there was no big crash over the last 12 to 18 months, when accessibility of debt obviously went down, it's because of the critical shortage of properties. So whilst demand had to recede because, people just couldn't afford what they could, supply was receding at an equal, if not disproportionately higher rate. And that's why we've seen markets move. But on your point around debt, I think it's a massive thing, because middle of the year, we're having these stage 3 tax cuts, right? If you go and have a look around LinkedIn, or, you subscribe to brokers' emails or whatever, most brokers who are talking about it are estimating that these stage 3 rate cuts alone are going to probably add about 5% onto people's borrowing power.
That's what they reckon.
5%, yeah. So you have that, right? That's coming through no matter what, right? That's coming in. So people come mid-year, going to get a 5% boost straight away, right? What do we think that's going to do for property prices for people who were on the edge? They're now jumping in with 5% extra.
Yeah.
We've then got potential rate cuts also at that same point in time. I read some AFR article this morning, all right, and we all know how good some of the mainstream media can be around this stuff, but I don't disagree, to be honest, with this point. Some of the rate cuts alone, this potential 1 or 2, could add upwards of 10% to property prices alone, right? So I couldn't actually find any opinion pieces basically on a 25 to 50 basis point drop, how that correlates into your borrowing capacity. But I'd be expecting off the cuff, it's quite a bit. If these stage 3 tax cuts are only going to be adding in $1,000, $2,000 into people's pockets, and it adds 5%, a 25 to 50 basis point decrease in interest rates probably going to be adding a little bit more than that, right?
Yeah, and I need to run the numbers. I'm not familiar with them, and I you hear all the noise around stage 3 tax cuts, particularly for sort of middle income earners, and you go, well, it's a couple of grand, really. Does that make any difference? And it must do. The government bangs on about it, and they'll tell you it's a great idea. But whether or not that translates into a 5% increase in service, really. But the issue you have, though, and what it comes back to, Lachlan, is that even though you say whatever the bank will give you, don't consider that you've got to take the maximum.
Yeah.
But people always take the maximum.
Yep.
They go, my budget's just changed. They said I could borrow $500,000 before it was only $400,000. I'm going to go and spend $500,000 now as a debt on a property. People always do it.
Yeah,
always do it. Hence the reason why property prices go up. There's an argument to say if everyone's sort of still invested within their means and what worked for them rather than the maximum that what the banks would actually provide in terms of debt, property market shouldn't change that much. Bet they do.
Well, and that's why as well you see as disposable income increases, people's household expenditure increases because I don't know, it's just human nature that when we've got more money, our first instinct isn't to either invest it more wisely or save it or whatever we want to call it. Our first instinct is we want to spend it, right? And we want to buy more consumer goods. We want to buy that bigger house. We want to do all that stuff because we feel like we can, and there's obviously that misnomer in property that the more expensive, the better it is, right? But it also applies to lots of other things, right? You go from buying an Oraton handbag to buying a Louis Vuitton, right? Or something like that, right? Because people always want that next bigger thing because, we love that, right? As human beings, we love that type of thing.
You like Oraton handbags?
Love me an Oraton handbag, absolutely. But I think it's a great point you raise because that's then what fuels the market because you've got people who were going to spend $500, they're now spending $550, right? And those people that were spending $550 are now spending $600. And the best part is, from a property ownership point of view, is they might not buy at the $550, but now they buy at the $520, and that just fuels additional people in that bubble that then go, all right, well now $520s are worth $580. Right, and $580s are now worth $650, and $650s are now worth $720.
Yeah, it's you get the upside of it if you do own property.
Yep.
And the smartest property investors I know don't dictate their buying choices based on how much debt a lender will give you. They're a lot more considered about it. Look, it might help sort of give you a sense of the bracket you can be investing in, but
Definitely.
often a $550,000 house might be a better investment than a $650,000 house. It depends on the timing, where it is, what it is, what its condition is, what the markets do in those areas. So this is sophistication that good investors have. Other than sort of looking at where interest rates might head, what other data are you sort of considering as you shape sort of investment decision making in the second half of this calendar year, 2024?
Well, I think it's important not to overcomplicate it, right?
Yeah.
I think a lot of the time, and you see gurus out there, and you see all these people, talking about all these fancy things, and I think often I'm a big believer in just keeping it simple, right? KISS principle, keep it simple, stupid, right? At the core of the price of any good or service is supply and demand, right? That is the core of it. If you've got more people that want it than it's available, the price is going to go up. Yeah. And then if you've got less people who want it, then it's going to go down, right? It's as simple as that. So I think looking around some of the core metrics around supply and demand is a really safe way of trying to understand where a market sits, okay? I think from my point of view, what's some data we can look at? Firstly, inventory levels, okay? So for those people out there who might not know what inventory levels are, basically it's, of all the properties that are on the market versus how many typically sell in a month, how many are there, right? So if you've got 30 houses that sell in a month and you've got 30 properties listed, that means you've got 1 month of inventory available, right? But if you've got 30 properties that sell and you've got 60 on the market, you've got 2 months of inventory, right? Right now, there is almost no inventory out there, right? So there's, a roughly loose idea out there that, maybe like, depending on who you talk to, maybe like 3 to 5 months of inventory is a balanced market, right? Probably maybe more like the 4 or 5. Most places, they're like 1 or 2 months, right? Some places are under 1 month, right? And of course, data, you then get issues with the validity behind it. For example, days on market, right? Days on market is an indicator of demand, right? Because the longer a property stays, the less demand there is. So the less days on market means the quicker it's selling, which means the higher demand. Days on market are really short right now. Typically, probably in the 30 to 40 range, and it's sort of 60. So 2 months is sort of the estimated, balanced market type of prospect. From what I see, 30 to 40 is nowhere near accurate, right? We see properties that either get listed online or get offered to us as an off-market or pre-market opportunity. They're gone in a couple of days. And the data validity side behind it, or accuracy side, can be skewed because if a property gets listed and then it goes under offer, an agent might not update that, right? And then say you've got a 2 or 3 week period of condition. So maybe you've got a finance condition or a building condition or things like that. They might wait until all those things are satisfied. So the property is now, the contract is now at an unconditional state before they update that listing to say it's now sold. So suddenly a property that sold in 2 days suddenly says it's 21 days on market.
Yeah.
Right? And then you can obviously extrapolate that out on how you get to 30 or 40. So putting that aside, most data sets are saying it's like 30 to 40 days, right? 20 to 40 days, which is already so tight, right? If 60 is balanced and you're at 30, you're at half.
Yeah.
But there's also a lot of skew in that, right? So I think inventory days on market, massive, right? And I know people always love to hear some data. So I've got some data if you'd like to hear some.
We like data.
Yeah? All right. So I've picked just a handful of places that either we might be investing in right now or maybe we have been investing in or that people, you know, if you get on forums or Facebook groups or whatever, people are talking about these areas, right? So basically there's some hot areas and I'm not going to say what ones we're in or what we're not or things like that, but I'm just going to throw some names out there, right?
Here we go.
So, for example, right, we've got an area like Canning in WA. Right? Canning, right? So it's in that southwest Perth area.
Yeah, Andrew Hasey is the federal member for Canning.
Yeah, Andrew Hasey. And then with my background, he's a former defence member. So he's
he's now got he was Shadow Defence Minister. Now he's also the Shadow Defence Industry Minister.
Oh, so he's picked up 2.
He's got 2 now.
Wow.
Yeah, that happened last week.
Busy bloke.
So,
I didn't see that one.
Yeah, he is. But he's a good operator.
Well, there we go. So now
Canning. There you go.
So we got the area of Canning, right? A suburb of Canning, right?
Yeah.
Let me rephrase that. It's the region of Canning, right? So there's some other suburbs that come under the banner, but we're looking in the area of Canning, right? Average inventory right now in Canning is about 2.3 months, right? So pretty tight, right? So supply, inventory, how much is available? It's 2.3 is pretty tight, right? Yeah. However, the average inventory change from 12 months ago to now is it's decreased by 0.75, right? So we've almost stripped a whole month of inventory out.
Yeah.
Over a 12-month period.
So it's getting tighter, so stuff's moving faster.
Very tight, yeah. Average days on market, 46, okay? Again, having an idea of where that market is and having an idea of how quickly things are moving, I can promise you it is moving faster than 46 days, right?
Yeah,
so we've got some data skew in there. But
so this is your point saying that if you sign a contract today, and it depends where you are in Australia because different rules apply. If you sign a contract today, you could pretty much get yourself up to 21 days to pull out of that contract.
Yeah.
So it marks it from the day it's signing, the day after the sort of the formal sign happens rather than, so you're losing 21 days essentially.
Easy.
Yeah.
I mean, you could even get to 28, right? If you think if a property gets listed, let's say they go for a week, right? The vendor says, I want a week. I don't care how many offers you get. I want you to show it once or twice. I want a week on there.
Yeah.
Then a week's gone. Then let's say that you had you're able to negotiate very strongly and you got a 3-week contingency period for finance or building and pest or whatever. You're now at 28 days. Yeah. Let's say you had a delay with finance, which is, not uncommon, especially with how quickly things are moving. Yeah. You asked for an extra week, right? You're now at 35 days without really having to do anything, right? 35 days, right? A week, 3 weeks of contingency, an extra week on the back end because of finance.
And then you've got your standard sort of settlement period, right?
Exactly
and
right.
That adds on to it.
Exactly right. Or you could have an agent that just doesn't even click sold or whatever until it's actually settled. And now that's suddenly 40, 30, 35, 42, 40, 49, 55, 60. Like there's some very common periods. And data gets skewed, right? So there you go. Canning, right? Hot as anything. I'll give you one more. Maybe I'll put some other ones as we go.
All right.
Let's go another one. Mount Gambier, right? That one gets thrown around a little bit in circles, right? So South Australia. So Mount Gambier, average inventory level, 1.76 months.
Okay.
All right.
Lots of people want to live in Mount Gambier.
Yeah. Average days on market, 40. Pretty, we're 20 days under the balance point. We're a third under. Pretty quick, right? And again, you think about what we've been talking about with the accuracy of data. Pretty easy to see how that gets skewed, right? The rent over the last 12 months, it's up 11% or $40.
Yeah, okay.
Right? So you think somebody who bought in Mount Gambier probably enjoyed a pretty fruitful last 12 months.
I'd imagine.
Right? So, like I said, they're just some suburbs or areas just to sort of pull out to illustrate the point. And I'm sure people listening are going to go, oh, I've heard of those areas. I might have even looked at them myself. But I think, keeping it simple, supply and demand governs everything, right? And you can see some of these areas that are pretty hot, right, or have been hot, that supply, almost non-existent. That demand, very high. Add in the rents because cash flow is obviously important. Even if right now, and most people would see it's pretty hard to buy a cash flow positive property with where rates are at, and especially if you're doing
at 80% LVR.
Yeah.
I saw a report today come in from PEXA that said a quarter of all properties in the eastern seaboard states over the last period of time, I just only briefly looked at this, bought with cash.
A quarter? Did they have a comparison to?
I didn't look. I just saw the headline. I quickly skimmed it. Yeah, quarter paid with cash in the eastern states. So there's a lot of people still buying with cash, right? So it's positively geared on that basis.
Absolutely. We've got a lot of clients who are older, right? They might be 60 plus, and they've sold their principal place of residence. They've downsized. They've had a sea change or a trade change, or just or even a city change, just to somewhere smaller. And they might have owned that property for 20, 30 years. They've had a good chunk of gains out of it. Obviously, no tax because of the
capital gains
exemption.
Place, yeah.
And then they're now going, okay, well, we've got all this excess cash. We were already comfortably retired beforehand. Maybe we've got $1 million or $1.5 million, and they're coming to us and saying, can you go and buy us an asset that, it could be a house, it could be a unit block, it could be whatever it is. And they're not necessarily saying we want to chase a cash flow focused asset. They're just going, we want our capital to be working effectively. So we're buying, a $650K property cash outright, or a, $900K small block of units or something.
Yeah.
So I can attest to it's probably valid.
It's out there. They're mainly downsizers, and they're parking that dough. A lot of them actually give it as a living will, where they might farm that out to their kids to give them a head start on property. But others are chucking in other assets, and it's free cash flow. So there's lots of data there, and I think there's some good clues to how to sort of intersect what's happening with interest rates versus local market dynamics. Welcome back, Phil Tarrant, chatting with Lachlan Vidler. Now, Lachlan, so you're painting a picture which says property investment sounds all right into the remainder of 2024 and beyond, which I would expect you to say. Naturally, seeing that you work in property. But to pick up an earlier point you made is that, a lot of people won't take action on this. And no doubt for some people to be, I'm just unsure. I don't know what's happening. I can't get my finances sorted out. I really don't know what the interest rates are going to happen. I don't want to risk it right now. Interest rates are too high, et cetera, et cetera. What would be your sort of your clear message to listeners out there so they don't avoid missing out? And if you're saying that we're going to get a similar run to what we did over that 2021-22 period, before interest rates started going up and slow the market down, you don't want to be. If you missed out that first time, how do you not miss out the second time?
Yeah, it's probably something I always get really emotive about, because I just see that many people who we speak to who then just take no action. And I say to probably all of them, I honestly couldn't care less if you come work with us. It's not really about that. It's about the fact that I see so much opportunity cost lost because people don't take action. And a really obvious example to me is the amount of times in a conversation where we're talking with a client who's about to sign on, and obviously, there's always nerves, right? You work with them, you work with an accountant, you go and get your nails done at a salon, right? There's always nerves with any sort of service provider about, am I going to get value or quality for what I do? But the conversation, I couldn't even count how many times I've had is saying, what is your alternative right now? Like, you're not happy with where you're at. Otherwise, we wouldn't be having a conversation, right? So what is your alternative? And then they'll sit there and they'll think, okay, well, I could just keep saving. But then very quickly they realize, well, I can't save my way to a good retirement, especially now. Then they think, okay, what do I could go in the share market, right? And we'll have that conversation. Well, that could be a very viable option, and a diversified portfolio is very good. But again, for most people, the benefit of property is leverage, right? So let's say you got $100,000 and you're going to try and buy yourself a $500K property, right? With that, and it's a 15% deposit and your costs in there. If that $500K property that you bought with $100,000 goes up by 10%, you make $50,000, right? So you made 10% on the asset value, but you make 50% on the capital you invested, right? $50,000 of capital growth against the $100,000 you invested, and that doesn't even include the rental return that you've had as well, right? If you look at the share market, if you invest that same 100 and you get that same 10%, you're only going to make $10,000. So when we have that conversation, flesh it out with people, it's not about what's better or worse. It's about how can you make your money work more effectively. For a lot of people, if you can borrow, because that's often the linchpin, well, property makes a lot of sense because you're going to get a far better return on your capital invested. So for these people, it's about understanding, okay, well, what is the alternative? And most of the time, there is no alternative. There's no genuine alternative to property.
Yeah.
Especially if you're 30, if you're 30, you're a bit younger. So, maybe you could make your millions in the share market. But if you can make your millions in the share market with that same capital, I'd argue you could make 5 or 10 times that in property. But if you're, in your 40s, you're in your 50s, time isn't on your side. You want to leverage, you want to use leverage to your advantage to try and, capitalize as much as possible. But I think the first and probably most important thing I'd say is you do need a plan. And something you mentioned earlier in the show was about how people, when they find out that they've got more money at their disposal, at their fingertips, right? And whether that's, an inheritance or whether that's because their borrowing capacity's gone up. And now they're not looking at their, $650K property. They're now looking at their $800K property. That's why a plan's important, because every purchase should have a purpose, okay? And that purpose could be, hey, we want this to be a balance of capital growth and cash flow, okay? Or it could be we want this to be really heavy cash flow. Or it could be that we want it to be really heavy capital growth. Now, what I will say is I find that one a bit hard because you can't buy a capital growth property. I'm going to just say it out there. I don't care what people say. There is no evidence that any one location is a better capital growth play. And the common one is go blue chip if you want capital growth. But the reality is Mount Druitt grew more over the last 20 years, or at least last time I looked at the numbers, grew more over the last 20 years than, like Cronulla or some of the eastern suburbs.
As a percentage.
As a percentage, right? So when people say, I want a capital growth property, I find it a bit of a misnomer because there's no such thing, in my opinion, as a capital growth property.
Yeah.
Right? It's either a good property or it's not a good property, but you can't go and just invest in one location for the next 20 years because you believe it's solely going to be a capital growth play. So coming back to it, that's why a plan's so important, because every property is going to have a purpose. And when you've got your plan, it doesn't matter if you get an inheritance. It doesn't matter if your borrowing power goes up. It doesn't matter if we get stage 38 tax cuts and now you've got 30% more borrowing power. You know what you're buying and you know why you're buying it. And you know how it then fits the bigger picture. And then you craft your purchasing strategy out of that by going, this is why we're doing it, this is what we're looking for, and this is why we're doing it. So that's probably the first thing I'd say,
Okay. Lots of info there. What have I got to do next?
What have I got to do next?
Well, don't get stuck. You can't sweat the small stuff when it comes to property investment. If the timing's right, if you can get debt and you're comfortable around your ability to continue to manufacture money professionally in whatever job that you're doing, you're never going to time the market perfectly. And I don't really have a view on it. It's not really my forte, but your position is there should be a period of capital growth ahead of us. So
absolutely.
And there's always somewhere growing somewhere in Australia. Maybe Canning's right. Maybe that's.
And I mean, people can't see it, but I've got about 6 more suburbs on the list.
Sure. Got Rockingham on there.
Yeah. What else did we put on there? Look, Tamworth's numbers, Rockhampton's numbers, Toowoomba's numbers, Moreton Bay's numbers.
Moreton Bay.
Like I said, I picked a cross section of
a lot of Queensland properties there.
Yeah, but I mean, I guess probably the other thing I would say is this is where your research and analysis becomes so important, right? If you've got your plan, you've got your purchasing strategy, you need to be able to track those markets because markets are moving very rapidly, right? If we go back 2 or 3 years ago, if you could only buy a 300K property, there was a smorgasbord of available areas, right? These days, it's really hard to buy a house under about 400, 450, right? Yeah. It's getting really difficult to do that in a market that you want to be in. So monitoring and understanding, unpacking the data, like what we talked about, a handful of suburbs and 2 or 3 data points, right? There is so much more that goes into it than that. But being able to track that and understand that and see how things change, because numbers in isolation are never good. You need to understand how they change over time because that gives indications of future direction, things like that. You need to be able to monitor that. And a lot of people either don't have the money to be able to buy the data to do it, they don't have the time to do it, or they don't have the knowledge or experience to be able to do it as well, because this is not something that is created overnight. It's not something, that happens there. And I love the old, I don't know if you call it a parable, but there's that story of, the guy who's a mechanic on ships. He comes in and there's, the engine's not working and they hire him in and he walks in, he looks around a little bit. And he just sort of fiddles around a bit, and he picks up his hammer and he just taps it in one spot, right? And then the engine comes back to life. And he hands the people the bill. On the bill, it's itemized. It says, effort $1, 50 years of experience, $10,000, right? And how it relates to this is everyone always feels really comfortable because we live in property or around property. Property is a pastime in Australia. But strategic investment and the knowledge and experience and analysis to do it is very different to my neighbour at the barbecue said we should do this. And it looks all right. I know it. There's good people that live there. I'm going to do it, right? Yeah. So we need that. And if you don't have it, it's pretty simple. Go get help. And I guess this is where I say, come and have a chat with us, right? Come and have a chat with me and the team at Atlas Property Group, because this is what we do every day, right? This is where we have our experience. We were 2023 National Buyers Agency champion last year. In the Australian Small Business Awards. We're always up for REB Awards as well. We've got that experience and we want to help you, because at the end of the day, even if you chat with us and you don't like what we have to say, maybe it'll make you take action in another way. Or best case, of course I'm going to say it, you're working with us, we're going to help you build that portfolio. But taking action is the most important thing.
Yeah, and hopefully this is a sage reminder for all those people out there who are on the sidelines waiting to get in, that was it imperfect action trumps perfect in action every time.
100%.
90% of winning is beginning.
Exactly right.
There's numerous ones.
Miss every shot you don't take.
Yeah, you miss every shot you don't take. So, well, thanks for coming in, Lachlan, having a chat with us, mate. It's really informed. Always enjoy catching up. It's good to hear things are motoring along for you guys. And, I like doing this podcast because it just reminds me, and as you sit there and you're talking, I'm thinking about my portfolio. Just going, despite all its headaches, sort of bookend my initial sentiments, despite all its headaches, I can deal with 8%, 9%, 10% compounding average annual growth, because the number adds up. And I always look at the arbitrage between capital growth versus the arbitrage between what does it cost me to hold a portfolio in interest repayments versus the capital growth that I'm getting from it. And if there's a nice big fat gap there, that makes me happy.
100%.
Even in markets which are hard.
100%.
Which it has been. It's, haven't had the growth that we had over the last year or so and increasing in rates. But the gap is still good enough to make the juice worth the squeeze.
Yeah.
It's a really easy way to look at it
100%.
if you've got a long-term view on holding real estate assets. So, it's cool, man. Well, thanks for coming in. What's next for you guys? Anything?
No, I mean, I guess really it's sort of, for just driving through this year, just helping as many people as we can. We're bringing out some really cool tech stuff within the business that's going to help a lot of people out. I guess for us, I'd probably just say to people, if you want to come and have a chat with us, our as I was saying before, right, I think probably one of our biggest calls is, we average like 19.6% average growth each year, right? So if that's the kind of performance you want, come and have a chat. And then secondly, if you've got a portfolio, jump on Talvr, TALVR, so talvr.com.au, jump on, plug your portfolio in, and then you can start to manage it a lot more effectively. And then, as I mentioned right at the start, we've got those exciting updates coming. And if you've got a buyer's agency team, you can get them to jump on board and be able to manage your portfolio a lot better. And
so other buyer's agents, you have them using it?
Sorry?
Are you happy with other buyers' agents using it and all that sort of stuff?
It's not an Atlas tool, right? Yeah. So it's a completely separate business. It's I've stood this up with my tech co-founder. It's a completely standalone separate business, and it's designed out there because the amount of times I have people coming and saying, "Help me analyze my portfolio, or help me do this," or how do I know that you guys are always looking out over my portfolio? And hearing all this stuff, I thought, well, why don't I just go make something that's going to solve that problem? Because whether it's a buyer's agent, whether it's an investment provider, whether it's anyone else, all these types of people can use the platform, and then they deliver a better experience to clients. Clients have a better experience with their provider. Everyone's happy.
There you go.
And it's a good time for everyone.
Nice one. Thanks, Lachlan. Lachlan Vidler, Director at Atlas Property Group. We're getting back in the studio. We'll pick his brain about some more. We'll give us some more locations next time. I'll give that to him as his homework. But thanks for coming in, mate.
It's taken years, and we've finally started to talk about some places.
Got some numbers from you. I hold him accountable now. But I look forward to seeing how this this market cycle moves once interest rates start coming down, and hopefully it's productive for property investors, and I'm sure it will be. Thanks for tuning in. Remember to smartpropertyinvestment.com.au, social media, Smart Property HQ. You can follow us across all the social platforms. You'll find us on Instagram, Smart Property Investment. Check it out. Heaps of videos and stuff going through there. As a challenge for you all, let's grow that as quickly and rapidly as possible. The Instagram platform for Smart Property Investment. Go and find it. You'll find it really easy. You'll probably see this snippet here as we speak about it right now. Thanks for tuning in. We'll see you next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.